DR Congo is banning dollar cash payments in a high-stakes bid to take back control of its economy. Published by Business Insider Africa. The Central Bank of the Democratic Republic of Congo is making one of its boldest attempts yet to curb the dominance of the US dollar, announcing a ban on all cash transactions in foreign currencies starting April 2027. DR Congo will ban all cash transactions in foreign currencies from April 2027. The move targets widespread dollar use and weak confidence in the local franc. Authorities want tighter control of money flows and to exit the FATF gray list. Success will depend on enforcement in a heavily cash-based, informal economy. The Central Bank of the Congo said individuals and businesses will no longer be allowed to make or receive payments in dollars or other foreign currencies in cash. Commercial banks will also be prohibited from physically importing foreign banknotes. Foreign currency transactions will only be permitted electronically through the banking system, a move authorities say will improve oversight of money flows. Governor André Uwameso said, from April 9, 2027, no person will be authorized to carry out cash transactions in foreign currencies. A high-stakes gamble against entrenched dollarization. The decision targets a deeply entrenched system. Decades of instability and hyperinflation in the 1990s, when inflation surged to around 2,000%, pushed Congolese households and businesses towards the dollar as a store of value. Today, the economy remains heavily dollarized, with most transactions above $5 conducted in U.S. currency. The Congolese franc trades at roughly $2,300 per dollar, compared with about $920 in 2010, reflecting long-term depreciation and weak public confidence. Previous attempts to reverse this trend have struggled. A 2024 directive forcing electronic payment terminals to accept only francs had limited impact, as dollar cash continued to dominate informal and retail markets. By targeting physical dollar circulation, the new policy goes further than earlier reforms, but also raises enforcement risks in a largely cash-based economy. Tied to global financial pressure. The move is not only about currency control. It is also linked to efforts to exit the Financial Action Task Force gray list, where the country remains due to gaps in anti-money laundering and counter-terrorism financing systems. Recent reforms, including stricter laws adopted in 2022 and expanded in 2025, have tightened reporting requirements for banks and businesses. The Financial Intelligence Unit, CNRF, has also been given stronger powers to track suspicious transactions. By forcing foreign currency use into traceable banking channels, authorities are trying to close loopholes in cash-based transactions that are harder to monitor. Stability improving, but vulnerabilities remain. The policy comes at a time when macroeconomic conditions have improved, giving policymakers room to act. Economic growth is projected at 6.2% in 2026, supported by mining and steady non-extractive sector activity. The country remains central to global supply chains for critical minerals such as cobalt, a key input in electric vehicle batteries, attracting sustained interest from the US, China, and Europe. Inflation has dropped sharply to 2.2% year-on-year as of March 2026, from over 10% a year earlier, prompting the central bank to cut its benchmark interest rate to 13.5%. However, currency pressures persist. The franc has weakened on the official market this year, and the gap between official and parallel exchange rates highlights lingering structural imbalances. Regional and global relevance. The Democratic Republic of Congo's move mirrors a broader trend across Africa, where governments facing currency volatility, including Nigeria, Ghana, and Angola, have intermittently tightened controls on foreign currency use. But Congo's case stands out for its scale and difficulty. With over 100 million people in one of the world's largest informal sectors, enforcing a cash ban on dollars will test both state capacity and public trust. If successful, the policy could strengthen monetary sovereignty. If not, it risks pushing even more activity into the informal economy, the very outcome authorities are trying to avoid. Recommended articles. Nigeria becomes net petrol exporter for first time in decades as Dangote refinery scales up. 10 African countries with the highest fuel prices in April 2026.